Hi, Mike Almala, recovering CPA, back at you with another exciting installment of Financial Accounting Immersively Brief Introduction. The best way to understand the accounting measurement system is through the fundamental accounting equation. Assets equal liabilities plus equity. Now picture the accounting equation as a teeter-totter. On one side of the teeter-totter you see assets, and on the other side of the teeter-totter you have liabilities and equity. Unlike real-world teeter-totters, the accounting teeter-totter must always remain precisely balanced. Another related way to think about how accounting measurement works is to recall Newton's third law of motion. Every action leads to an equal and opposite reaction. Except in accounting, we rephrase this law slightly to say that every transaction on one side of the teeter-totter must entail an equal increase or decrease in some other account on the opposite side of the teeter-totter. So increasing an asset by a certain amount means that either a liability or equity has to increase by the same amount. Now, it's a bit more complicated than that because some transactions involve only accounts on one side of the teeter-totter. For these types of transactions, an increase in one account must be offset by a decrease in another account on the same side of the teeter-totter. This teeter-totter and fundamental equation is also the basis for the most basic of accounting reports, the aptly named balance sheet. A balance sheet reports what a business owns, its assets, what it owes, its liabilities, and what remains for the owners, its equity, as of a certain date. This equation in the balance sheet is always in balance. For example, if a business has $1,000 of assets at a particular time, those assets must be matched by the total of the claims of creditors and owners. Here is one of an infinite number of acceptable balance sheets. So let's look at the left side of the teeter-totter, the asset side. Assets are things that can be used to generate revenue through the sale of goods and services. Assets include things like cash, inventory, furniture and equipment, and accounts receivable. Now, GAAP, generally accepted accounting principles, assumes that all assets of a business are either owned outright by the business owners or are subject to the claims of creditors. Creditors are anyone that has loaned money to the business. Loans and other forms of extended credit are called liabilities. The portion of assets not subject to claims by creditors is called equity. In the GAAP framework, equity can be viewed as the difference between assets and liabilities. Rearranging the fundamental accounting equation, we get that equity equals assets minus liabilities. By common law, if business ceases operations, the priority claims on assets go to outside creditors. The claims of owners can be realized only after outside creditors' claims are satisfied. As such, equity represents the owner's residual claim on business assets. Now, subclassifications of assets and liabilities are called accounts. These accounts mirror the names of the most common forms of assets and liability. Here are typical asset and liability accounts. You should be aware that there are two subclasses of the equity section of a balance sheet involving owner contributions and owner withdrawals. These contribution and withdrawal accounts have different names depending upon the legal structure of the business. If you can keep this teeter-totter and Newton's law analogy in mind, you will better understand the logic of accounting measurement. As we go through this course, I will be revisiting these analogies again and again. Now, I want to close by saying that all students and users of financial accounting should note that this fundamental measurement framework, the teeter-totter and the basic equation, date back to the 15th century when the structure and scope of business ventures were much simpler than they are today. It very well may be that this framework strains too much when applied to the complex business ventures that operate today. Click the next video for a discussion of revenue and expense accounting.